You can also work as a capital adequacy manager in the commercial banks. That is, you will be in charge of the bank capital, the last item on the liability side of the balance sheets. Bank capital is actually the net worth of the bank. That is, if you sell all your assets and pay off your liabilities, what's left is called bank capital. If your bank capital is negative, what does that mean? That means if you sell all your assets and that is not enough to pay off your liability, then you go bankrupt. Therefore, a commercial bank goes bankrupt if their bank capital is negative. Now let's see these two examples. This commercial bank, keeps a high bank capital. So they have $10 million of bank capital. But this bank only keeps $4 million of bank capital. Now, what happened if the banks have some bad loans, like what happened during the financial crisis, during the recent financial crisis? You have to write off your loans. It's like the example we just talked about. Remember, you sell securities. If you have to sell something, you will have to lower the price. Say in this example, if actually you have to sell $10 of security in order to get $9 cash, because you will have to lower the security price from 10 to 9 to sell it. Then on the asset side, you only have $99. On the liability side, you should also have 99. Then where is that dollar should be off? The answer is your bank capital will have to be lowered by $1. That is, you write off $1 of security because you have to sell it. Same thing happened here. If you have a bad loan, if you have $5 million of bad loan, then your loan decreases by $5 million from 90 to 85. The asset side, you have 95 left. On the liability, you should have 95. So where is that $5 million? The answer is your bank capital will have to reduce by $5 million. So because of these write-off of bad loans, these high bank capital banks will have a bank capital of $5 million left. They still survive. However, look at this low capital bank. Same thing, $5 million of write-off. But originally, this bank only kept $4 million of bank capital. Now $5 million less, result, bank capital is negative. Therefore, this bank goes bankrupt. Therefore, as the bank capital manager, you will have to keep an adequate bank capital to avoid bankruptcy. The regulator, that is the central bank, the Federal Reserve Bank, they also set some bank capital requirements to prevent banks from going too aggressive and going bankrupt. Therefore, if you are a bank capital adequacy manager, you will have to keep the adequate bank capital to meet at least meet the regulatory requirements. You want to keep the bank capital higher to avoid bankruptcy and give the investors higher confidence in your bank. However, if you have a higher bank capital, the return on equity is going to be lower. Why? Remember, bank capital include two parts, right? Equity and retained earnings. Now say equity. Say for example, this bank issue 100 stocks, 100 shares of stocks. Each share is $10. Therefore, their equity will have $1,000. If this bank earns $1,000 and want to distribute this $1,000 as dividends, then what is the return on equity? That is, each share of the stock will earn how much money? The answer is you have $1,000 to distribute to 100 shares. Each share will earn $10. However, if the bank equity, the bank issues 200 shares. Again, each share is $10. Then the bank equity will have $2,000. Therefore, in this case, bank capital is higher, $2,000 compared to $1,000. However, when the bank earns $1,000 and they want to distribute this $1,000 as dividends, what is the earning on equity in this case? The answer is I'm going to distribute $1,000 to 200 shares. Therefore, each share will only earn $5. Did you see that? So higher the bank capital, the lower the return on equity. Therefore, if you have a higher bank capital, your bank is safer. Investors will have more confidence on your bank. However, your owners, your stockholders will not be happy because now they will get a lower dividends. Therefore, there is a trade-off between safety and equity return. That is why, as a capital adequacy manager, you will have to keep an adequate capital, bank capital. Say for example, if the bank experiences a lot of write-off, so bank capital shrink, they're in trouble. In order to meet the Federal Reserve Bank's requirements, as a bank capital adequacy manager, you will have to increase bank capital. Then what should you do? First, should you sell more stocks or retire some stocks? The answer is you sell more stocks to raise more money and put in the bank capital. Or should you increase dividends or decrease dividends? The answer is to decrease dividends to increase the retained earnings, because remember, retained earnings is also included in bank capital. Therefore, if you want to increase capital, you either sell more stocks or decrease dividends in order to increase the retained earnings. Say for example, today your bank have the shareholder meeting and the shareholders are not happy. The shareholders complain that their return is too low. If the shareholders complain that the equity return is too low, then as a capital adequacy manager, you want to decrease the capital, the bank capital. Then what should you do? The answer is you want to retire or buy back stocks to reduce the equity of the bank. And equity is part of bank capital. Therefore, you can reduce the bank capital. Or you can increase the dividend. That is, you use the retained earnings to distribute dividends to the shareholders to make shareholders happy. Therefore, if a bank wants to decrease capital, then they have to either retire stocks or reduce retained earnings to increase the dividends. Finally, if you want to work in a commercial bank and you want a very high salary, then you want to be a risk manager in the bank, because this is the most important job in a commercial bank. You will have to manage interest rate risk for the bank. Your salary is going to be very high. Here we are going to introduce two tools to manage interest rate risk in the commercial banks. The first one is called gap analysis. The second one is called duration analysis. These two are also two of the tools that the Fed is using to do the stress test on the commercial banks. You probably see these stress tests on the newspaper. This is the test. These are the tests that the Federal Reserve Bank conducts on the commercial banks after the financial crisis to make sure that the financial market is stable. So here we are going to introduce two of the stress tests. The first one is called gap analysis. Let's talk about the details of the gap analysis. Here is the basic idea. This is the commercial bank's balance sheets, assets and liabilities. Now, what we are going to do is we are going to group the assets into two categories. The first category is called rate-sensitive assets. Rate-sensitive assets. Sensitive to what? sensitive to market interest rates. That is, when market interest rate increases, the interest rate on rate-sensitive assets will increase with the market interest rates. If the market interest rate decreases, the interest rates on the rate-sensitive assets will decrease with the market interest rate. So those assets are called rate-sensitive assets. The second category is called fixed rate assets. That is, the interest rates on these assets are not moving with the market interest rate. They are fixed for a longer period of time. Say, for example, variable rates, short-term loans. Variable rates, it is called variable because their interest rate is moving with the market interest rates. Short-term loans, their maturity is lower. Therefore, when the loans or the securities, short-term securities, when their maturity is met, then you sell the security, buy a new set of security, short-term security, then the interest rate on the new set of short-term security is going to follow the market interest rate. Say, for example, you have a 3-month treasury bill. Originally, it is 1%. And when market interest rate increases, after this 3-month treasury bill mature, you're going to get your money back and then buy another new set of short-term securities, which will have an interest rate of higher than 1% because market interest rate increases. Fixed rate assets, reserve. Reserve interest rate is fixed. Why? Because it is fixed at 0%. Because cash and reserve item does not earn interest. Long-term loans, long-term securities, because the terms are longer, you are locked in the contract for a longer period of time, therefore they are fixed rate assets. We do the same thing for the liabilities. Rate sensitive liabilities and fixed rate liabilities. Variable CDs, they are called variable rate because their interest rate moves with the market interest rate. Money market deposit account, remember what is money market? The market that trades only short-term securities, right? It's lower than 1 year. Therefore, again, when it expires, you issue another new set of money market securities, then the interest rate will move with the market interest rates. Checkable deposits are fixed rate liabilities. Why? Because their interest rate is fixed at 0%. Long-term CDs, savings deposits, their terms are longer, therefore they are fixed rate liabilities. Bank equity, capital, bank capital, again, they don't earn any interest, or you don't have to pay any interest. Checkable deposit, you don't have to pay any interest. Therefore, they are fixed rate liabilities. The gap analysis only focus on 2 parts of these 4 parts. That is, the gap analysis only focused on rate-sensitive assets and rate-sensitive liabilities. In our example, we have $20 million in rate-sensitive assets and $50 million in rate-sensitive liabilities. So we only focus on these 2 parts and ignore the fixed rate assets and fixed rate liabilities. So what is gap analysis? Say for example, when market interest rate increases by 5%, then rate sensitive assets, their interest rate will also increase by 5%. That is why they are called rate sensitive assets. Okay, first, on the asset side, do you earn interest or pay interest? The answer is you earn interest on assets. Therefore, your interest receipts on the rate sensitive assets increases by 5%. And you have $20 million in rate sensitive assets. Therefore, your interest receipt on your rate sensitive assets, on your asset side, increases by 5% of $20 million, which is $1 million. On the liability side, do you pay interest or receive interest? The answer is you pay interest because this is liability. Therefore, your interest payment increases by 5% because market interest rate increases by 5%. And you have $50 million of liability. Therefore, your interest payment of liabilities increases by 5% of $50 million, which is $2.5 million. Now, if you are a risk manager, if you work for the bank, your bank's interest receipt increases by $1 million, but interest payment increases by $2.5 million. Are you happy? The answer is no, you are not happy. Even though you receive $1 million more, but you also pay $2.5 million more. So in net, you lose $1.5 million. So your change in profit is this increase in $1 million receipt minus the increase in interest payment, which is negative $1.5 million. As you can see, it is actually the 5% increase in market interest rate multiplied by the rate sensitive assets, $20 million, minus the rate sensitive liability, $50 million. So we call this rate sensitive assets minus rate sensitive liability the gap. That is why it is called the gap analysis. Okay, the bank does not do anything. They don't sell more liabilities, they don't buy more assets, they don't do anything, but they lose $1.5 million simply because the market interest rate increases by 5%. This is why it is called the interest rate risk. What is risk? Risk is uncertainty. What is interest rate risk? Interest rate risk is uncertainty about interest rate. What interest rate? When we buy assets, sell assets, we know the interest rate. So you know the interest rate. So what is the uncertainty about interest rate? The answer is the uncertainty about future interest rate. If you don't know whether future interest rate will go up or go down, you will have gain or loss or lose or loss. Therefore, this is called interest rate risk, uncertainty about the future interest rates. In this case, the bank does not do anything simply because market interest rate increases by 5%. They lose $1.5 million. As you can see, if market interest rate goes down by 5%. What happened? Interest receipts will decrease by $1 million. Interest payment will decrease by $2.5 million. Are you happy? The answer is yes. You receive $1 million less. However, you pay $2.5 million less. Therefore, actually, your profit is negative 1 million minus negative 2.5 million, which is $1.5 million. That is